Hello traders and welcome to a new video of 5 Minute Alpha. So what I'm going to be doing today is giving you guys the most alpha or the most market edge within 5 minutes. So let's begin. So the Delta Exchange just opened up a new contract called Option Spreads and they offer up to 200 times leverage. So let's dive into what these are and how we can make money, okay? So an option spread is when you buy and sell a call at different strike prices or when you buy and sell a put, as in this case, at different strike prices. The first strike is what you buy, and the second strike is what you short. And this creates something called an option spread. This would be called a put spread, a long put spread, long put spread. And if you also wanted to, you could also short this and long this. But let's talk about how to do that. If I go ahead and buy this contract, I'm essentially betting on price expiring below 29,800. Okay? This would be the P&L. Actually, it would change to this, but this would be the P&L. I would either lose $10 if I bought this, as you can see, because I'd be paying that in premium, or I would actually gain 90. So the risk reward of this play would be 9-1. Now, whenever you take a play going long, you actually don't have to give any margin. Look, the premium is just going to be $10. But there's kind of an exploit, I wouldn't really necessarily say an exploit, but something that you can do with these contracts that are pretty good, especially right now. So they offer a lot of margin for shorting, which means that, let's say I want to short this thing at $9 right here. Let's go over what does that mean and what would that look like? Well, I would flip these two signs because that's, yep, and this would be the P&L. Because I'm shorting at a price of $9, this would be, a $9 spread. So what would end up happening is I would either gain $9 or I would lose 91. Now, what's so great about this? Well, what's great is the fact that I really can't be liquidated. I can't be liquidated because if I give up $100 in margin and just max short this thing, I can't lose more than $100, and this spread at most loses 90, so I'm just not going to be liquidated. The benefit of this is this allows you to short volatility with a lot of leverage, okay? For those that don't know, shorting volatility tends to take a lot of margin, especially in other exchanges like Deribit. But if you were to short this contract right now, you'd only need to put up $100. And if this expires, it would give you a 9% return within 1 day. Your premium of 9 divided by 100. So these are really, really cool plays that you can now trade option spreads. There's one caveat though. What you want to do is if you're ever going to do this kind of play, you got to be careful to make sure that the distance between the strikes is only $100. Why? Well, watch this. I'm glad you asked. So if we go to a contract that doesn't have an $100 difference, this one has a difference of $300. That means that if you were to short this, this could expire to a difference of $300, meaning this could go to 300. If I market sell one, I put up 150 in margin, but I could actually be liquidated on this contract. Don't believe me? Well, watch this. So if we simulate this contract, we know that I could short this contract for $15, right? So to do that, let's just put this one to 30 and the one to 15 to simulate shorting this contract at $15. As you can see, I can actually lose 285, but I'm putting up 150 in margin. That means I can be liquidated. So the big alpha, what you can do here that is so good is whenever there's an $100 difference, you really can't be liquidated. Unless really you really can't be liquidated. So you get to short with leverage. Really, without any risk of liquidation, which is just outstanding. If we look at this contract, if you guys want to know how to simulate this, it's super easy. All I'm going to do is I'm going to get rid of this. Predefined strategies, I'm going to go to a long call spread. That's going to pop up there. I'm going to change this to 1 Bitcoin, which is 1,000 contracts. And the contract we're looking at has a strike bought of 29,800 and a strike sold of 29,900. So here would be the P&L. So if I was to buy this contract at $80 right now, I would need to put up, $80 in premium. And my max gain would only be like $8, so probably not a great deal. But what I could also do is I could short this, put up $100 in margin, and then I have no chance of liquidation, and my max risk would be as you can see, $8. So really the big alpha of this is you're now able to bet on volatility with very tight spreads. They also reduce the fees on this too. There's reduced fees. There's like look how tight these contracts are. There's only like a $1 difference with these option spreads, which gives so much opportunity. Now, for a contract like this could technically just give you passive income. What you do, if you short this thing at $2, essentially what you're saying is if you short this at $2, you're either going to make a $2 profit or you're going to lose 98. Okay, that would be the P&L of this contract right here. Now, on a margin of 100, that's a pretty good deal, I'd say. So that's how these contracts work for spread plays, which I think are just really, really, really cool because now you can bet on no volatility, i.e. this one right here, and not have to face any liquidation risk. So these are just new things that Delta has offered, up to 200 times leverage when you go short. That's why a lot of these margins are only $100. So really, really cool way to trade. You know, you could also do something like buying this contract. If you buy this at 3.5, your max risk would be $3. But if price expires below 29,500, this contract would expire to $100, which would make you a lot of money. And that's the way that these spreads work. When they're in $100 difference, whatever you buy, like right here, the amount of money that you can make would just be the difference of this minus what you bought it at. When you short, it's the same thing. It's just this minus this, and that's the max that you can lose. So you could lose 98 if you short this, or if you buy this, you can make like $96. A $96 return if we buy at $4 and then exit at 100, which would be possible, would be a 25 times return. So not only do these contracts allow you to not just liquid trading, not just can I bet on a event not happening, like shorting this contract right here and just earning a $2 premium per $100, which is nice, with no chance of liquidation. It's pretty good. What I can also do is I could get a 25 times return if I just buy this contract right now. And if price does expire below 29,500 today, which it probably won't in 17 hours, but if it did do that, then I would, if it went down here, I would get 25x my money. So that means that if I, was really confident, I could put in, let's say I buy 100 at a price of 4. 100 at a price of 4 for like $400. If that, if price did just absolutely tank, then buying this put contract would make me 25 times 400, which would be a lot of money, which would make me $10,000. So yeah, a lot of things you can do with these spread plays. What I really like to do is something more like this is more my style, where I'm using margin to basically bet on things not happening. So earning $8 and, at a max risk of 92, but of course the choice is yours. I think that these contracts are great with the reduced fees. They're really, really liquid with every single contract, even the contracts that aren't even being traded. But again, I would shy away from ones that don't have an $100 difference, because if they don't have an $100 difference, then the max loss you could lose if you short is a lot higher. Okay? So that's going to be it for today's video. Learn a lot about options before you get into something like this, something like playing spread plays. But what I will say is this is probably the simplest type of options trading besides just buying or selling a call or put. This is probably the simplest way to do it. So yeah, it's super simple. I could just buy this and it expires to $100 at max, or I could just short this and yeah, and it will probably expire to $0. So that's going to be it for today's episode on the alpha of the week. I think that a lot of alpha here. If I was to short this right now at $5, and if price expires above 29,700, I earn $5 for every $100 that I put in. Choices are yours. We went over 5 minutes, but kind of happy we did because I got to air out all my ideas with trading option spreads. So now there is an order book for option spreads, which is very, very helpful. With that being said, of course, I'm not endorsed by Delta, the Delta exchange. I'm just showing this because I think it's pretty cool and a good way to earn money on lack of volatility, especially on the weekends. Shorting these contracts could be quite good if you're shorting a far out of the money contract. With that, happy trading, and I'll see you guys in the next one.